Welcome back, everybody, to Andy the Banker Show. And for today's episode, I wanted to talk a little bit about our national debt that's happening right now, and as well as the brand new BRICS currency that has been released. And it's expected to release with the main goal of taking over as the reserve currency. Now, in terms of my portfolio, just to give you a quick update, I haven't done any changes recently. I haven't contributed or I haven't taken anything out. I actually been on vacation. And when I'm on vacation, I typically have higher expenses than normal. And during those times, I don't, my portfolio stays the same. I've been to Seattle and I also went to Portland. It was an amazing trip. All right, back to the topic. I want to discuss a little bit about the national debt. All right. And why is this a big deal? Why am I caring about it? Currently, our national debt is $35 trillion. All right. Now, in case you guys may not know, how much we take in revenue, how much we make in tax revenue is around approximately $5 trillion. So that is 7 times what we make, right? We owe 7 times what we make. So to give you a good example of this, right, is imagine you have a friend, okay? Your friend makes $100,000, and your friend he also borrowed $700,000. All right, so he's in debt to you. He's gonna pay you back in 30 years. However, he wants to keep on borrowing money. He wants to borrow an additional $40,000, and he promises that he's gonna pay you back within the next 40 years, 30 years, I'm sorry. My question is, would you be likely to keep on lending your friend more and more money? And with most people, they may say no, because the person only makes $100,000 a year. The math sometimes is not mathing, right? So one of the ways that kind of worries me is if people stop buying national debt. And when I say national debt, I'm talking about, for example, the 30-year bonds. Okay, so currently they're trading at around 4.544% for their yield. And if less people buy these 30-year treasuries, these bonds, then what that means is that the bond yields have to go up in price to be more lucrative for investors to get into. So why does this matter, right? Ultimately, who cares if the bond yields go up? Well, it's because the 30-year bond yields are very correlated with our mortgage rates, our 30-year mortgage rates. And they're currently, the mortgage rate 30-year fix is around 7.39. So if all of a sudden these bond yields spike up to, let's say, 10% or even 8%, then you can bet for sure that our mortgage rates are also going to spike. And if the mortgage rates spike, then everybody's going to get affected. Me, people who have homes, or people who want to buy homes, they're going to be less likely to do so because the interest rates are just going to be so darn high. Now, you might be saying, Andy, the U.S. government has so many ways to take care of this. For example, the first thing the U.S. government can do is just print more money. Simple, right? Print more money. Well, there's one issue with that. If you were to print more money, it's inflationary. And I don't know if you guys noticed what happened 2 years ago, 2022, when inflation goes out of control, interest rates have to rise. Right? You saw Jerome Powell do that the last 2 years. And if interest rates rise, you saw on your Robinhood, you saw on your brokerage accounts, stocks get heavily impacted by that. Higher interest rates typically means contracting economy, right? Potentially leading to a recession. So that's one, that if the government were to print money. The second option is, hey, you know what, Andy? Let's just tax people more. All right, let's just tax everybody across the board. More people, more corporations. Well, you can do that. You can definitely tax people more. And if you tax people more, that means there is less liquidity in the market. There's less cash for people to spend money on. And if there's less cash, people are spending less money because they have less money based on the taxes. Then that's a contracting economy. Again, that would lead to a recession. And that's why it is such an important topic for me, because I am an investor. I have literally all my net worth is in stocks. All right? I have no real estate. I have no other appreciating asset besides stock investing. So that's why when I take a look at this, I take a look at this national debt as something that's like a black swan event that's coming my way. Now, I just want to let all of you guys know, even though I know this news, I am still going to be buying US stocks. That's not going to change. This is not a bearish moment where I'm selling out of everything. I'm actually buying more into stocks. What I am trying to do here is just trying to increase awareness that, hey, by the way, this bad thing could happen to your stocks, that whether they increase the taxes leading to a contracting economy, or whether they print more money leading to inflation. These are things that could impact your portfolio. So with that being said, the way I'm investing is going to change a little bit. All right, just a little bit. For example, I'm gonna be putting a little bit more emphasis into Costco stock. All right, because in both of those scenarios, the government prints more money or has more taxes. Costco, in the first scenario with higher inflation, I've seen it before where Costco has been able to pass those inflationary costs to the consumer. As a customer, yeah, it sucks, don't like it, but as an investor, that I think that's amazing for Costco. Now, are they going to be able to do it again? I don't have a crystal ball. I can't tell for sure. However, that's my opinion on it. That if they were able to do it before, why not in the future? And in the second case, where let's say people have less money to spend, all right, because there's higher taxes across the board on everybody. Costco sells things at, at the lowest margins. They sell. Their goal is to sell you things as cheap as possible and mainly make money off of the memberships. I like that business, right? Now, the type of businesses I am not interested in right now, knowing this news, I don't want to be in a business that is heavily leveraged. Like, what do I mean by that? What do I mean by heavily leveraged? Like, for example, imagine every time I have to buy this product, I have to borrow money. For example, car companies, right? When I buy into a car, typically I'm gonna do it with an auto loan. All right, and most customers will do it with an auto loan. Why is that mattering? Because let's say they print more money to pay off this national debt. One way to fight inflation, you increase the rates. You increase the interest rates, just like Jerome Powell has done the past 2 years. And if you increase the rates, you're gonna notice that people are less like, they can afford cars less. They can finance things less because the interest rate is gonna increase their monthly payments. Okay. As a result, things that I need to finance, solar panels, right? The cars, big appliances. So those are the type of things I'm gonna try to stay away from, because they will have less of a bargaining power, because their products will be a lot more expensive. Not a fault of their own, by the way. All right, and not a fault of their. I want to make that very clear. It's not gonna be their fault. It's because of the federal chair, that they have to get inflation under control, and as a result, things like that, it's going to impact the cost of their products. Now, I want to dive a little bit deeper into this bond rates. Why does this national debt matter to bond rates? Currently, right now, people have, I want to say, they have high confidence that the US can pay back its debt. Currently, we make approximately $5 trillion. We owe $35 trillion. So people are they're still confident in it. However, there will come a point, in my opinion, where people might say, hey, you know what, this is looking kind of dangerous. Like, maybe I don't want to invest in the US market, because look at how much money they owe. Like, can they really pay us back? And once we lose that confidence, I hope not. I really hope not. But if we do happen to lose that confidence, it's going to impact these 30-year treasuries. All right. And I'll give you an example how. Okay. Imagine I am the US government and I got to build a freaking bridge. Okay. For some reason, there's a hurricane or there's something, and I have to build a bridge. And I go to the market, the public market, and I say, as a US government, I say, hey, you guys, I need to build this bridge. I'm offering a yield of 4.547%. Who would like to buy these 30-year treasuries so I can build this bridge? And luckily, right now, I have buyers. But imagine a case where people are not lending money to us. So I say, oh, shoot, I still need to build this bridge. Okay, I still need to build it, yet people are not lending money to us. So you know what? I'm going to have to increase these yields to 6%. Okay, I get a little bit of buyers, but I still need more money, because I have to have this bridge be built. There's no other option. So then I might say, okay, fine, I'm offering an 8% yield. to build this bridge. Okay, at that point, some people might be more interested. They say, okay, I wouldn't lend you money at 4.5%, but I'm happy to lend you money at 8%. Now, when that happens, you can bet for sure these 30-year mortgages are going to be impacted. And this is the worry that I have. Okay, if the mortgage rates go so high that people can't afford the monthly, they can't afford to own a house, the demand for the house goes down. That leads to some people are cash poor, house rich. That if the price of those homes go down, we could have some serious issue in that, which will impact essentially everybody. And that's a worry that I currently have. If less people are able to afford homes, are not able to keep their homes, that for sure is impacting my stock market, right? The stocks that I currently invest in. Now, one news that really struck me big time was the introduction of the BRICS currency note. All right, this currency, I don't want to say $100, but 100 BRICS bank note was very interesting to me, and the timing of it all, right? It was released in a time when people are starting to worry about the U.S. national debt that is finally 7 times more than what we currently make. We make $5 trillion. We owe $35 trillion, and I see what they're trying to do, right? Their goal is to decentralize the dollar. We use less dollars and use more, other currencies, and that can be a bit of an issue for us as an investor. If there is less people using the US dollars, we're not the reserve currency anymore. That's going to lead to less liquidity. Less liquidity in the market will definitely have an impact on our stock market. And that's something that I, as an investor, am currently worried about. I'm not 100% sure how likely they are to succeed, but if this national debt keeps on going higher, right? Right now, we owe 7 times what we make, but let's say it goes up to 100 times, right? Instead of right now we make $5 trillion, let's say we owe $500 trillion. Then at that point, some people might be like, hey, you know what? I don't want to buy US debt anymore. Some people might say, I want to buy, instead of US 30-year treasury, they may buy a different country. So it's very interesting on the timing of how this banknote was released. And with that, you guys, I want to hear your opinions. I want to see it in the comments. Let me know what you think about all of the national treasury and the potential solutions. I don't have a solution for it, I'll be honest, right? I don't know how they're going to get out of it without causing an inflationary byproduct. But yeah, let me know in the comments. And with that, you guys, thank you so much for watching Andy the Banker Show. I'll see you in the next episode. Thank you.